Welcome to podcast series for revision of accounting standards. These podcasts are designed by Mori classes. In today's episode, we are going to discuss about the framework for preparation and presentation of financial statements, an essential topic for CA Inter. This framework, issued by the Accounting Standards Board of ICAI in July 2000, is the fundamental basis for developing and reviewing accounting standards. It outlines concepts for general-purpose financial statements for diverse users. The framework covers key areas, including components, objectives, underlying assumptions, qualitative characteristics, and elements of financial statements. It also details criteria for recognition, principles for measurement, and concepts of capital and profit determination. It serves various purposes, guiding enterprises in preparing statements, assisting the ASB in developing standards, helping auditors form opinions, enabling users to interpret financial statements, and informing stakeholders about the ASB's approach. The framework applies to general-purpose financial statements of all commercial, industrial, and business enterprises. Special-purpose reports are generally excluded. Importantly, it does not override specific accounting standards. In case of conflict, the standard prevails. Financial statements comprise the balance sheet, statement of profit and loss, cash flow statement, and notes and other statements. Each component provides distinct, crucial insights into an enterprise's financial health, performance, and cash movements. The primary objective of financial statements is to provide information about an enterprise's financial position, performance, and cash flows to help users make economic decisions. While serving common needs, they cannot provide all necessary information, such as non-financial data. Key users include investors focused on risk and return, employees interested in stability and profitability, lenders ensuring loan repayment, and suppliers and creditors concerned with timely payments. Other crucial users include customers interested in the enterprise's continuity, government and agencies for resource allocation and taxation, and the public informed about the enterprise's broader impact and activities. The framework identifies three fundamental accounting assumptions: going concern, accrual basis, and consistency. If financial statements are prepared following these, no disclosure is needed. However, any deviation must be explicitly stated. The going concern assumption posits an enterprise will operate indefinitely with no intention to curtail operations. Financial statements prepared on this basis account for asset replacement and liabilities. Any departure from this assumption requires disclosure of the basis used. Under a going concern, PPE is depreciated over time. Further, stock is at cost, or NRV, whichever is less. Penalties or discount on early payment of liabilities are ignored. In a non-going concern, PPE is at net realizable value. Liabilities include early repayment penalties, trade payables reflect discounts, and deferred expenditure is fully written off. The Companies Act mandates accrual basis of accounting for companies. Further, Accounting Standard 9 on revenue recognition lays down the principles for recognizing revenue on accrual basis. If cash basis is used, it must be disclosed. Under accrual basis, revenues and costs are recognized in the accounting period in which they are earned or incurred. The timing of actual cash flow is not important. Consistency ensures accounting policies are applied uniformly across periods, enhancing comparability. Comparability should encourage improvements, not just uniformity. Changes are permitted only in following three cases: if required by law, or if required by standards, or for a more appropriate presentation. Qualitative characteristics enhance the usefulness of financial information. Within reasonable cost/benefit limits, the framework suggests four key attributes: understandability, relevance, reliability, and comparability. Understandability means financial statements should be clear and accessible to users with a reasonable knowledge of business and accounting. This ensures the information can be effectively interpreted. Reliability means information must be free from material error and bias, faithfully representing transactions. It should uphold substance over form, remain neutral, exercise prudence with uncertain outcomes, and be complete. Comparability allows users to analyze financial statements across different companies and over time. Disclosing the impact of policy changes is essential. However, it should not hinder the adoption of improved accounting standards. Financial statements are mandated to present a true and fair view. While the framework doesn't directly define this, applying its qualitative characteristics and relevant accounting standards typically ensures such a presentation. The framework categorizes financial statement items into 5 groups: asset, liability, equity, income, including revenue and gains, and expenses, including expenses and losses. Gains and losses are part of income and expenses, respectively, not separate elements. An asset is a controlled resource from past events expected to yield future economic benefits. Key points include physical substance not being mandatory, control over the resource is more important than legal ownership, probability of future benefits, and reliable measurement of cost or value. A liability is a present obligation from past events, expected to result in an outflow of economic benefits. Key points include the obligation's probable existence, legal or customary enforceability, and reliable measurement of the outflow. Provisions for asset diminution are not liabilities. Equity represents the residual interest in an enterprise's assets after deducting all liabilities. It signifies owner's claims, distinct from other liabilities. Equity changes due to capital contributions, distributions, income, and expenses. Income increases economic benefits through asset inflows or liability decreases, leading to increased equity, excluding owner contributions. It includes revenue from ordinary activities and gains that may or may not arise in the ordinary course of business. Income recognition requires corresponding asset increase or liability decrease. Expenses decrease economic benefits through asset outflows or liability incurrence, reducing equity, excluding distributions to owners. This includes regular expenses and losses. Expenses are recognized when corresponding asset decreases or liability increases occur, often by matching with revenue or systematic allocation. Various relationships between financial elements define closing equity and profit. The underlying principle being profit is the difference between opening and closing capital adjusted for additions and drawings. The amount of capital depends on valuation of assets and liabilities, thus reported profit changes with change in the valuation basis. This forms the basis of capital maintenance. Measurement determines the monetary value for recognizing financial elements. The framework outlines 4 bases: historical cost, current cost, realizable value, and present value. These primarily apply to assets and liabilities, with profit implicitly derived from changes in their values. Of these 4 measurement bases, the accounting standards largely use historical cost for preparation of financial statements. Historical cost records assets at acquisition price, including all related costs. Liabilities are recorded at the proceeds received or expected settlement amount. Current cost values assets at what an equivalent asset would cost today, and liabilities at the undiscounted amount needed for current settlement. Realizable value for assets is the cash obtainable from their orderly disposal. For liabilities, it's the undiscounted cash expected for settlement in the normal course of business. Present value measures assets at the discounted value of future net cash inflows and liabilities at the discounted value of future net cash outflows. This involves discounting future amounts to their current worth using a specific interest rate. Capital maintenance ensures a business's net assets are sustained to allow continued operations. Profit is the excess of closing equity over opening equity after accounting for capital introduced and drawings. Retained profits value depends on asset and liability valuation basis. The capital maintenance can be checked in all the 4 measurement bases of financial is non-negative. Capital is considered maintained. This assumes sufficient funds for asset replacement at historical costs, applicable when prices are stable. Under the current purchasing power convention, opening and closing equity are restated using average price indices. A positive retained profit means enough funds exist to replace assets at average closing prices. However, this method has limitations as individual asset prices don't always change at an average rate. Physical capital maintenance at current costs restates asset and liability historical costs using specific price indices. Positive retained profit ensures funds for replacing each asset at its closing price, aiming to maintain the enterprise's physical operating capability. This concludes today's episode on the framework for preparation and presentation of financial statements from the podcast series Revision of Accounting Standards by Mori Classes. I trust this detailed discussion has provided clarity on need for framework, components and users of financial statements, fundamental accounting assumptions, qualitative characteristics of financial statements, 5 elements of financial statements, their interrelationship, 4 measurement bases, and the concept of capital maintenance. I wish you the very best for your forthcoming studies and examinations. If this video was helpful, please share it with others. We at Mori Classes greatly appreciate your support, including subscribing to our channel and leaving comments with your feedback and suggestions for future topics.